Die Sprachübertragung beginnt jetzt. Alle Teilnehmer befinden sich im Zuhörermodus.
So, hello everybody. A warm welcome to our first BAI webinar of this year, 2026. We kick off with a webinar on infrastructure debt, the market opportunity, why now, and why it is a strong addition to your portfolio. And I'm happy to welcome Daniela Jönsson and Rupert Murphy from Ares. Roland, please, the next slide for the short agenda for today. So after my opening, I will show you some data from our investor survey on infrastructure debt, and then I will hand over to Daniela Jönsson, who is partner and relationship manager Europe at Ares Management, and she will introduce to you Ares. Probably most of you will know it already briefly. And then I'm happy to welcome Rupert Murphy, who is partner and head of EMEA Infrastructure Debt Ares Management. I'm particularly happy to welcome Rupert because like 2 years ago, I had the pleasure to interview her with an expert interview for our infrastructure report 2024 on infrastructure debt. And back then, Rupert pointed out several tailwinds making infrastructure debt attractive, like decarbonization, digitalization, and e-commerce, boosting logistics and transportation infrastructure. And therefore, she emphasized the importance of flexible, innovative financing solutions. Now, the question of today, are those points still valid in the current market environment 2 years later? And have developments since 2024 changed the attractiveness or dynamics of infrastructure debt? Roland, please, the next slide. And from our investor survey last year, we can see what are the key drivers for infrastructure debt investments. We can see that diversification is the most important driver why German institutional investors invest into infrastructure debt, followed by risk premiums compared to liquid bonds. And there are several strategies investors are pursuing, with core senior strategies as the key ones, and opportunistic high yield not playing that big of a role yet. So it will be interesting to hear from you, from Rupert, if she confirmed those trends and what she recommends in practice. She will give us a key study. She will give us a case study on infrastructure debt. Our events. This is the first event of this year, as I mentioned. First time that we can meet in Frankfurt will be in 2 weeks, the Private Debt Symposium 2026 at the Scandic Hafen Park in Frankfurt. There are still places, so there's still open slots. So if you want to register, please register. You can find it on the QR code. You can find all the information on our events. Then at the end of April, we have our annually flagship event, the Alternative Investor Conference at CAP Europe in Frankfurt. And then at the beginning of February, we have another webinar on infrastructure, private market benchmarks for portfolio risk management and regulated institutional investors, which will be provided by our member companies, Scientific Infra and Private Assets, together with Substance Over Form on the 5th of February. So now I hand over to Daniela, who will briefly introduce to you Ares.
Many thanks, Florian. It's a pleasure to join the very successful webinar series of BAI and to anchor the year with our first webinar on infrastructure debt, which is a very important and relevant topic for a lot of investors. It's so great to see many known faces and names joining us today, and some faces that are new. So very much look forward to connecting with all of you at some point in the future, in particular at the Private Debt Symposium in 2 weeks' time, and also at the Alternative Conference in April in Frankfurt. My name is Daniela Jonsson, and I'm a partner here at Aries Management. I also lead the relationship management effort for the DACH region. We have a large number of investors in DACH, insurance companies, pension funds, asset managers, family offices, and we've built a very strong business in the region over the last 10, 15 years. If we can skip to the next, maybe to the whole disclaimer, so today we will be, I'll just introduce Aries to you, and then the main discussion will be led by Rupa Murthy, who is a partner and who is heading the European portfolio, European activities of infrastructure debt. As a reminder, who is Aries Management? We are a global alternative management firm. We are active in largely three areas: credit, infrastructure, and real estate, or corporate credit, corporate private equity, real estate, and infrastructure. And we are active across the capital structure to create either investments in equity or also to create different type of financings. Today we'll be talking about how we lend money to infrastructure assets. Aries is a truly global firm with more than 55 offices across the world where investment teams are based, people who day in, day out originate assets. And that's very important for us. They're all integrated and they speak to each other. Our DNA is in credit, where we've been active really since the beginning of the firm in the late 90s. And that's why for us, the most important things are the downside protection, creating diversified portfolios, and obviously attractive risk reward for our investors. On the next slide, we just want to zoom into our infrastructure debt platform. Since inception, we have invested in more than 25 billion of assets, so very deep and strong track record, nearly 100 investments across senior and junior loans. We've organized our capital in the form of commingled funds and some other vehicles. The team globally in 4 offices is 27 members strong, and on average, the partners of the team have 24 years of experience, so really deep experience in the market and also experience in working together. So I'm delighted to hand over to Rupa Murthy.
Thank you, Daniela, and thank you everyone for joining this webinar today. Very excited to be here to discuss infrastructure debt. As Daniela explained, my name is Rupa Murthy. I'm a partner and I head up the European platform for our global infrastructure strategy here at Aries. Let's kick off, and I really wanted to kick things off by asking a very simple question. What exactly is infrastructure? We at Aries really define infrastructure as assets and companies that provide very essential services to our day-to-day living. We are really looking for assets that have effectively the characteristics on the left-hand side of this slide. So assets that are providing these essential services, they have very high barriers to entry and are effectively providing you with a very long-term, stable and predictable cash flows. Now, these can come in the fact that they have monopolies in the areas they operate, or they have long-term contracts, or sometimes they're regulated, and so you have a very strong certainty of your revenue base. Effectively, this creates a very low-risk asset class, which continues to perform irrespective of macroeconomic environments, including things like high inflation, high rate environment. These assets, because of their essential nature, are very counter-cyclical and resilient. What this really translates into is 4 verticals that we concentrate on, which is on the right-hand side of this slide. So you could see digital infrastructure, digital to us is really assets such as data centers, fiber cables that are transmitting data, and your tower networks that are giving you the 4 and 5G networks. We have energy assets. These are typically your power generation assets, so your gas power plants, but also increasingly renewable energy plants that are generating electricity. Transport assets are road, rail, airports, and ports. And then finally, we also look at utilities, which are effectively companies that provide you with things like electricity, water, your heating networks, etc. All of this I know is very, very high level, so I wanted to put this in some kind of context. And with a little help of artificial intelligence, I'm now going to walk you through a day in my life, and to give you an indication or flavor how infrastructure really shapes almost everything we do. Go to the next slide. So here is, as I said, with the help of artificial intelligence, a very cartoon version of myself. As everyone knows, when you wake up in the morning, the first thing I do is reach for my phone. I'd like to pretend that, I'm checking the time, but the reality is, as soon as I wake up, I want to check my emails, I want to read the news. I have my phone by my bedside, so I'm charging the phone overnight. So already overnight, I'm using electricity provided by power assets or power generation assets, as well as the utility that's actually delivering the electricity to my home. As I scroll through my phone, I'm using all the data that's stored in the cloud, which is warehoused by data centers. I've got a fiber cable to my home to get access to data very quickly. And ultimately, all of this to say that within the first 5 minutes of waking up, I've used 3 categories of infrastructure already. So all of you know that after this, people get up, get ready, they go to work. So in the next slide here, you'll see me on my commute to work. I look very happy. I'm not always this happy in the morning, but nevertheless, this cartoon version of me is very happy. My commute to work involves me walking to the train station and catching 2 trains into the office. That already, by doing that, I'm already utilizing now the transportation sector that's available here in London, using the road networks, but also the London Underground tube system. So again, we are using the transport infrastructure as we commute. Equally, a lot of these assets, traffic signals, the traffic lights on the roads are using electricity. And so we're using the electricity, the generation assets, as well as the utilities to power and get us from places to places. So again, a couple of sectors of infrastructure we're using as part of your daily commute. Next slide. So here now I'm at work. I make my first cup of tea. I put the kettle on. I'm again using electricity. I power on my laptop. I have all my screens. I'm trying to get the best deals for Aries. Very hard at work. Very high usage of digital infrastructure now. I'm using data centers to access all this information. I've had the fiber cables to, process emails, transmit data very quickly. Sometimes I'm checking my phone and I'm using the 4 or 5G networks from the towers that are nearby. So all of this, again, saying that everything we're working around in the office is using traditional core infrastructure assets. And then finally, the next slide, you finish the day and you get home. And here I am trying to relax with my 6-year-old daughter, watching a little bit of television. Now, she's 6 years old. That generation, what I call traditional TV, which is sort of broadcasting TV, they don't know of. So for my daughter, the only TV she knows is streaming services. So that's a heavy use of data usage, which uses data centers and digital infrastructure to actually watch television. So a lot of my evenings are spent trying to find age-appropriate shows for her to watch. But I think you get the general picture. I think there's a very, very simple point here. And the point really is that, in everything that we do, every single moment of the day, we're using an enormous amount of infrastructure without even thinking about it. And we continue to use these assets because they're so essential to how we live our lives that as we continue to use them, we continue to pay to use them. And therefore, these assets become very low risk a very stable asset class that is generating very long-term predictable cash flows. I'd go on to the next slide. Here we go. So now we've defined what infrastructure actually is. Let me spend a little bit of time explaining to you why it's a very good time to actually be looking at this sector and investing in this sector. When you look at some of the big global trends that are affecting the world today, there are really sort of three forces coming together. You've got net zero transition targets that a lot of countries are aiming to hit by 2050, alongside decarbonization trends. You've got the massive rapid pace of digitalization occurring across the world. And of course, in more recent times, the enormous growth in artificial intelligence. Now, we've talked about a lot of these themes over a number of years, but the message is always consistent and it's always the same. It is the fact that in order to meet some of these megatrends, we need to be investing trillions of dollars in infrastructure assets to at least meet some of the demands some of these trends are creating. We'll take net zero transition or decarbonization as an example. In order to even get close to meeting these objectives by 2050, we need to be investing very heavily on cleaner energy, including investing a lot more in the build out of new renewable energy projects. So a lot more wind, a lot more solar plants all across the world. We also need to be thinking about things like the decarbonization of the transport sector. So moving away from these diesel cars more to, and petrol cars, to electrification of the entire transport sector and all the vehicles in that sector. That involves a lot of investing in infrastructure assets like charging stations, for example. Equally, look at cloud computing or artificial intelligence. In order for us to consume more data, if we're going to consume more and more data, we're going to start using AI in everything we do, we're going to need a massive amount of data centers, much more than we have today. We need to go out and secure land and build these data centers so that the technology companies can continue processing and building out AI. Now, that requires investing in data centers, but data centers only operate if they have access to very strong power. So alongside data centers, you need to build power stations to fuel the need coming from artificial intelligence and digitalization. So you get the picture. There's a lot of capital that needs to be spent. Florian mentioned that I talked about this in 2024. In fact, in 2024, globally, we spent something close to $2.3 trillion across various sectors within infrastructure to meet some of these demands. But the interesting fact right now is that's just sort of the starting point. We are expecting that number to grow year on year, almost by 15%, to the point where by 2030 even, we're spending over $5 trillion in infrastructure alone to meet a lot of these global trends. Why is that relevant? The relevance really is because there is a massive opportunity set here where you have significant, enormous opportunity actually to deploy capital in a sector that is growing very, very rapidly. And it's growing now, and it's growing, well into the future. Go to the next slide. So I've kind of outlined now what we think is infrastructure, why we think it's a good time to be in the sector today. I want to now spend the rest of this sort of presentation describing a little bit the opportunity set within the infrastructure debt asset class. But before I do that, I think it's good to take a step back and think about how is an actual infrastructure asset financed. When you look at an infrastructure asset, a typical infrastructure asset, typically you have something like 60 to 65% of the capital structure in the form of debt, and the rest in the form of equity. Now, if you tie that into what I've just been talking about, trillions of dollars of spend in the sector, 5.5 trillion yearly spend, 60 to 65% of that has to come in the form of debt. So again, you can see the vast volume of that capital spend is opportunities for infrastructure debt providers. So that's the first thing about why we find the debt portion of the capital structure very attractive. The second aspect I would say is you've got the senior debt and you've got holdco positions, but also you've got unitranche structure. So there are different parts of the capital structure that you can access to. But fundamentally, irrespective of where you're sitting in the capital structure, the underlying asset class that you're lending to, as I mentioned right at the beginning, it's a very safe and secure asset class because it's so essential to everything we do. So ultimately, you can be in the holdco position, the senior debt position, a unitranche position. You have access to an asset class that has very low default rates, so you have a very secure part of the capital structure. The third aspect, which I think is very compelling again for infrastructure debt, is the fact that it's a very highly structured piece of capital. And by that I mean, we spend a lot of time negotiating and very bespoke negotiations deal by deal on what the downside protections to be, because again, for us, a data center loan is very different to the way we lend to an airports, for example. So we have to tailor that loan to meet the risks of that particular industry and that sector and that company, and then look at the downside and protect against that. But one thing that's common across all of the different parts of the debt structure is the downside protection. So firstly, we have covenants. We have strong financial covenants in the shape of cash flow coverage when it's an operational asset, as well as leverage covenants. So if there's any deviation on the cash flow coverage of the company or leverage is going too high, we have the ability to call a default even before there is a non-payment of that loan. So well ahead of actual sort of crisis scenario, we can default on the loan, which is a very strong downside protection. The second very strong downside protection that we have in infrastructure is that we have security over real assets. So when you're in the senior debt position, you actually have collateral over the physical assets that you're lending into, which has extreme value. When you're at the holdco position, you also have very strong collateral because you effectively are getting shares in the company that owns all of these physical assets. So again, if you were to default, you have the ability to enforce on an entire company that has assets of extreme value. So we believe the security collateral that you get in infrastructure debt is very powerful and a very strong protection against downside scenarios. So from a risk perspective, we think there's a very, very good story about why the infrastructure debt is a very strong opportunity set. On the return side, you'll see that there is a bit of variance between whether you sit in the senior or the holdco position. The senior debt is, has a range of 150 to 300 basis points. At the lower end, it's typically because your assets are so solid and they're solid investment grade assets. So you're sitting at the senior first lien position, which is with security over those physical assets. The margins are not that significant. However, when you come slightly down the capital structure, just 10% more, you get a very big uplift in your margins, anywhere between 550 to 700. That's a significant premium to your investment grade piece. And this is where we think that has the best relative value in the whole capital structure. Actually, when you look at the returns, and we will talk about this a little bit later, the returns look are comparable to the equity in an infrastructure asset, but you have all the downside protection of a debt product, and also the risk profile of that holdco is more closer to the senior debt position than the equity. So again, from a relative value perspective, we believe the subordinated, the holdco transactions within infrastructure are very attractive. If we move to the next slide. We get this question a lot about, okay, so, infrastructure debt is a great asset class, but, we have quite a lot of exposure to corporate credit. How does corporate credit fare against infrastructure? The first thing I would say is that, we believe we compare very favorably with corporate credit strategies. On this slide, what we've done is done a study where we've taken a sample of companies that have an EBITDA of over 100 million and have leverage of about 5 times, the sample of companies from corporate credit and a sample of companies from infrastructure credit. And then we've mapped out the ratings of these loans. And you could see very clearly that the infrastructure credit loans on average have a higher rating than their corporate credit equivalents. And again, it's stating the obvious again, but the assets that we are lending to in infrastructure credit are so low risk, so resilient, it makes sense that the loans against these assets tend to be of a higher quality than their corporate credit equivalent, plus the downside protection, the structural protections you have that I've just described in terms of the actual infrastructure debt product. Next slide. Here we have a case where we are effectively comparing a global senior direct lending strategy against an infrastructure subordinated debt strategy to illustrate side by side, again, how we compare to other lending strategies. I've already talked about the credit profile of the companies. You could see very clearly in the infrastructure land, typically the parent company or the actual assets are very solid investment grades, unlike in corporate credit where it's more subordinated or a sub-investment grade. Then when you look, what's interesting is the next line, which is the tranche credit profile. Here we're comparing a senior or a first lien position in a corporate loan or a corporate company to a subordinated position in an infrastructure company. And you can see the ratings are exactly the same. And why is that? Because your parent company in the infrastructure land is a lot higher rated. So even with subordination, you get the same rating as a first lien or a senior position in the corporate, lending to a corporate company. So again, from a risk perspective, we believe we're very similar in terms of risk profiles across the two different strategies. However, again, downside protection, I'll keep talking about this, but downside protection is really the mantra of us infrastructure lenders. We are so focused on that all our loans are equipped with very strong financial covenants. Typically, we actually have 2 covenants. We have a cash flow coverage covenant, we have the leverage covenant, and we're always testing this typically quarterly or semi-annual to make sure the company is performing. And of course, the collateral as well, because we have the real physical assets that we're lending to. What I should point out though on this slide, and again, a question or something that, is in a lot of people's minds is, I have a very large private credit strategy. What does adding infra debt do to my platform? And again, we've done some studies around this. And the bottom line really is that there is value in adding infrastructure debt to a portfolio of private credit strategies because the correlation between the two strategies is fairly low. Again, we did a study where we compared infrastructure debt with Cliffwater direct lending indices and the S&P UBS leverage loan index. These are seen as proxies. They're public indices, which we have access to the information to, but they're seen as proxies to sort of a corporate strategy or corporate lending strategy. So when we compare an infra debt strategy to these types of indexes, you could see the correlation is so low that there is therefore benefits in adding an infrastructure debt to a portfolio to create that diversification benefit. Next slide. Great. So I've spent a little bit of time talking to you about how infrastructure debt compares to corporate credit in particular. It's also worth looking at how infrastructure debt fares compared to infrastructure equity. Now on this slide, we focused more on the returns because, again, we are comparing a debt product with an equity product. They don't have all the downside protections and the terms that you will typically see in a loan. Here we've mapped out 3 strategies. So an infrastructure subordinated debt strategy, an infrastructure core equity strategy, as well as an infrastructure value add strategy. And again, what is clear on this slide is for an infrastructure subordinated debt strategy, the median return is somewhere between 5 to 7% net returns. That is almost equivalent to what you're seeing in infrastructure core equity, albeit the infrastructure debt strategy does have higher variance, but it does have all the downside protection, all the covenants, the security, etc., that you don't get in the infra equity strategy, which is not on this slide. So again, from sort of an analysis perspective, we think subordinated debt, particularly in infrastructure, in the infrastructure sector, compares very well to a core infrastructure equity strategy from a returns perspective. So hopefully I've given you a flavor of sort of what is infrastructure debt and what it is, why we're excited about this sector, but also how it compares to other strategies, both credit and equity. I'm now going to sort of conclude this presentation through a case study and put it sort of all together. Sorry. 1 second. Here we go. My digital infrastructure wasn't working that well. Here we have a company called Nordic Ferries Infrastructure. It's a transaction we completed at the end of 2024. I think it's a very good case study to sort of put together all the topics I've been discussing today. The company itself, so Nordic Ferry Infrastructure, is one of the leading private ferry operators in the Nordic region. Effectively, they're called floating bridges because they are providing transportation services for the communities in that region, predominantly Denmark and Norway. As you know, the Nordics are surrounded by a lot of water, so often the routes that this company operates, there's effectively no other option but to use these ferries. So when we think about the definition of infrastructure, and we were talking about how essential services are, this company fits that definition perfectly. So we have a company that is servicing communities that have no other alternate routes of transport, so it's very essential. They have high barriers to entry because they have a portfolio of about 70 routes that they cover, over 100 vessels, and they're transporting close to 26 passengers every single year. So very high barriers to entry. They have long-term stable cash flows. Some of these routes, as I said, are monopolies. There's no other alternative transport, not even road or rail. Some of these routes are actually subsidized by the government. So you receive subsidies, again, to provide that resiliency in your cash flows. And finally, there's lots of diversification. So you have so many different routes to collect all of your revenues from. That also benefits and provides that stability in your cash flow. So it fits the definition of transport infrastructure very well. Now, the next topic we talked about was, why is it a great time to be investing in the sector? And again, very good case study here. This company operates, as I said, over 100 vessels running across the Nordic region. Most of these are operated by diesel. Now, the company has embarked on a massive capital program to electrify all of its fleet. Some of it is refurbishment of existing fleet, but some of it is building brand new electric fleet, as the company has ambitions to be 100% electric in the future. Now, that requires a lot of capital. North of $1 billion needs to be spent to electrifying this company's particular fleet. So they have been trying to raise this capital. Some of it has come from equity, some of it has come from the senior debt, particularly the Nordic banks, and then they needed some extra capital. So we provided that holdco loan I was talking about, a subordinated piece of capital for about 350 million euros to assist them in their decarbonization plans and to build out what will eventually be a fully electric fleet of vehicles servicing that region. So again, a mega trend that's shaping the need for capital in the sector today. The third, point that we discussed in this presentation was the nature of infrastructure debt and why that particular part of the capital structure is very attractive. And again here, without going to the returns are in the range I described of a subordinated loan, so very close to sort of the infra equity type of returns. But equally, it has everything that we talked about in terms of downside protection. Namely, we've got distribution blocks, and by that I mean when there's cash, when there's a bit of underperformance in the company, we can actually take the cash and lock it in an account and use that to repay our debt. In extreme circumstances where the company's performing even worse, we can actually lock up everything and default on our loan and take over the company. Equally, we have the security package. So we are the subordinated lender. We have shares in the company that owns all of these fleets. So again, in a downside scenario, if we have to enforce, we have ownership and we can actually own over the 100 vessels, which have extreme value in the market today. So very good, strong downside protection, high returning loan to service a very big megatrend in the world today. So bringing all of this together, I think I wanted to just conclude by saying that, infrastructure, hopefully by now you understand, is very integral. It's everywhere in our life today, often in places we don't even notice. The global trends that we're seeing in the market make it a very exciting time to be investing in the space, as the demand for capital is at an all-time high and is expected to continue in the future. And so the pipeline of opportunities is immense. And we believe, the loans that you have in this sector are highly structured, highly defensive, resulting in very low defaults in the sector as a whole, and makes that a very attractive proposition as an investment case. Thank you. And I think I'm going to hand it over now to Florian to see if there's any questions that I can answer.
Thank you very much, Rupert. I think we've gained a lot of insights about infrastructure debt, about the infrastructure debt asset class, but also how a typical day in your life looks like and how it's connected to infrastructure, which is probably true for all of us. Like we are all dependent on infrastructure, and it's one of the reasons why the asset class is this attractive at the moment. So I would like to encourage the audience to ask questions through the GoToWebinar tool. Some of you have already started, and we already have some interesting questions, but please, if you have questions, do not hesitate to ask them. We have a couple of minutes to have a short discussion with you, Rupert. So the first question is, why would you lend through holdcos and adding another layer? Why not lend directly?
So when you lend to the holdco, you are lending directly to the company. You're just subordinated to the senior debt, and as a result, you are able to attract a higher premium than if you were lending at the senior debt level. Typically, the companies put in place a holdco loan because there's some level of constraints at the senior. That typically comes in the form of a rating. So often is the case that the company either wants to maintain an investment grade rating or is forced to maintain an investment grade rating. So they can't raise more than a certain amount of debt at the senior level. And so, but there is enough cash flows in the company to justify higher leverage. So they will put in place a holdco loan to allow for that extra leverage, to utilize that extra leverage.
I think it's clear. Thank you, Rupert. Another question, like you mentioned the case study, you mentioned the existence of subsidies, state subsidies. So the question is, how important are state subsidies for the attractive conditions this asset class offers in general?
Yeah, it's a very good question, and it's something we diligence because there have been cases where subsidies have gone away, particularly in renewable energy. We structure the loan so that we have visibility over the cash flows during the tenor of our loan. And during the diligence, we see that the public subsidies, like there is no policies in place where they're going to phase that out during that tenor. Obviously, we look beyond that as well to make sure, if there is an issue with refinancing, for example, there is the benefit of long-term stable cash flows even beyond our loan. I mean, in this particular case, even if there's an issue with subsidies, one of the benefits of electrification is actually on the operating cost side. So right now, the company pays CO2 taxes for running non-electric vehicles, basically. And so with the introduction of electric vehicles, they can reduce their CO2 costs and so maintain that cash flows that are needed to service our debt. But equally, so there's an upside where the subsidies remain and you reduce your CO2 costs, or the worst case scenario, subsidies are leave the platform and but you have a reduced cost base. But as a lender, we do all these downside sensitivities. The great thing about this asset right now, it's generating a lot of cash, so the cash flow coverage ratio is very, very healthy. So even if they phase out subsidies over time beyond the tenor of our loan, we are very well covered from a lending perspective.
Thank you, Rupert. From an asset class perspective, where would you put infra debt? Part of the infra or credit allocation?
Good question. I think, I mean, Daniela may be better to answer this, but I know at least we tend to find a lot of our LP base is putting it in their fixed income private credit allocation, but we do have a few who put it in what I call an alternative infrastructure allocation bucket. But Danielle, maybe you have better color on this?
Yeah, actually, that's right, Rupa. We do have investors that are coming either from that put this in their infrastructure allocation because they might be the specialists in infrastructure and are seeing this as a kind of addition to their core infra exposure. But we also have a lot of investors that are saying this is actually direct lending. So it's infrastructure asset. So this is very much of a loan type of investment and part of my private debt or fixed income allocation. So we see both. It typically depends on how the investor is set up internally and how they're capitalized.
Thank you, Daniela, and thank you, Rupa. Another interesting question. What is the role of ARIS if projects face financial distress or even need to implement a financial restructuring? So I think it's a topic which is talked about a lot in the context of corporate direct lending, corporate private debt. So maybe you can answer it regarding infrastructure debt.
Yes, I mean, we are lenders ultimately, so our job is to make sure that we are, lending to very strong credit risk companies that don't have this issue. But if we are to face that issue, our role really is to, firstly, like if they have not tripped a covenant, but they are starting to see signs of distress, work with the company to see if there's any additional equity that can be put in to rescue. So we have constant dialogues with the company for that. Worst case scenario is if they have no more equity or no more cash to run the business, we are enforcing on our loan. And the great thing about infrastructure is we have those hard assets, physical assets that we are lending against it. So we have the ability to take over and, look at ways to restructure. Either we're selling the business or we're appointing new management. There's various forms in how you could take over a company, but that's the worst case scenario. Typically, it's sort of negotiations with the owners of the company and trying to work out how to put in additional equity into the business.
Thank you. I think this leads to the next question. You already mentioned the characteristics of tangible assets and collateralization in comparison to senior direct lending. So therefore the question is, you mentioned that, I think it was slide 13. If you could jump to slide 13, please, Roland. That under equal conditions, infradebt has higher credit quality compared to senior direct lending. Yes, so the question, what are the reasons for this higher credit quality compared to senior direct lending? I think you already answered it partly, but maybe you would like to explain a bit more.
Yes, so I think I was referring to the fact that the parent credit profile in infrastructure typically is much higher rated than a corporate profile. And actually the slide before this, where we've taken companies that have similar size and similar financial profiles in terms of leverage and looked at the underlying assets and what do the loans rate, you could see infrastructure credit, a lot more investment grade than corporate credit. But it goes to like the fact that we are lending to those 4 verticals of assets that are so essential that, whatever happens in the global economic climate, the geopolitical climate, we're going to continue to pay to use the water, to use the data, to use our electricity, etc.
Yeah, thank you. Another question, if duration is longer and putting to one side correlation point, should there be an additional yield or return premium for increased duration risk, especially if interest only, or is there an amortization feature?
So I think there's 2 parts to this question. Firstly, when you think about duration, it can vary. From a, again, holdco subordinated perspective, our duration is very similar to corporate lending. So we are sort of 5-7 year type loans in the holdco position. Senior debt can be slightly different, but senior debt, we're really talking investment grade. So I don't think it's comparable to corporate lending, which is not necessarily investment grade. So the second part of the question is, do you get a premium? The short answer is probably not, because the duration is not that different. However, one thing I didn't point out, which is a part of this answer, is we do get significant call protection in our loans. So again, we might structure a 5 or 7 year loan, 2 to 3 years at least we get of call protection.
Thank you. Another interesting question, who are your competitors, or who maybe you regard as your competitors at the project level? Are they rather fund of funds or individual fund managers?
Yeah, it's a good question. I would say, first of all, there are different types of ways you can play in infrastructure debt. There is sort of the mid-market as well as very large scale. There is probably more managers available to provide mid-market deals in infrastructure, less managers providing very large-scale debt for large-scale projects. In that scenario with the large-scale projects, even though there's not that many managers, probably the bigger competition is either the capital markets, so a public bond type solution, or it could be actually equity. So rather than putting as much debt, if there is a gap, they just put in more equity. But obviously there's pros and cons for both of those solutions. Capital markets, you have to time the access to the capital markets correctly if you want a certain price. It's a commoditized product, so it's not a structured bespoke like it is in private credit. And you're sort of, as I said, subject to sort of what is happening in the global markets at any given time. On the equity side, it's also a question of returns. Sometimes you're raising more equity that you might come from third-party equity. You're diluting your governance of that asset, so you have to give up some control of operating the asset versus getting an additional loan from a lender who is giving it to you, and you continue to operate and own that asset.
Thank you. I think this leads us to the next question regarding the capital structure. I think was the next slide, the capital structure.
I think one before, yeah.
One before, yes. You mentioned that there's the opportunity set regarding the capital structure. Could you emphasize the advantages and disadvantages of senior debt plus holdco versus unitranche?
Yeah, I mean, To be honest, it's a bit more of a preference of the borrower. The advantage of using a unitranche structure really is that it's simplification. You're not dealing with a group of lenders at the senior and then the holdco negotiating two set of documentation and then, you know, working out sort of the relationship between the two. You have sort of one pool of capital at the unitranche structure. The disadvantage is, you know, like I said before, a lot of the times you're constrained or you need to have an investment grade piece. And so you are trying to optimize and get that investment grade rating. You need to structure it as a senior investment grade piece. And then if you need additional debt, you put on a holdco tranche. So I think that's kind of the two variances.
Okay. Thank you. So I think there are no more questions. There were a lot of questions already from the audience. Thank you very much for asking all those questions and for your interest in today's webinar. If there's one more question, please ask it now. Otherwise, I will see many of you also from the audience in 2 weeks in Frankfurt at the private debt symposium, where there will be also slots, speaking slots and panels about infrastructure debt, and we can meet in person and discuss all those topics. Thank you very much to you once again, Rupa and Daniela, for your interesting presentation, for giving us all the insights and the case study about infrastructure debt. And thank you very much. Wish you a nice day and hope to see you soon.
Thank you, Florian.
Thank you, Florian. And we will put this information, this presentation online. But obviously, we have a lot of data. We cut our data different ways. So please reach out to us if you need any help, any support, argumentation. We are here to support you. Thank you and have a lovely afternoon.
Thank you
Have
all.
a lovely afternoon. Thank you.